Welcome back to Property Play. I'm your host, Elena Saradidis, and today I have my good friend Georgia with me. She is a fellow LePage signature agent. She's been in the industry longer than I've been alive, but she looks so good. I'm 12.
I'm older than that, a lot older.
She's been in the industry 34 years selling real estate. She's been in every kind of market, and she's been at LePage for 37 years. Back end, has done the admin. She's been a little bit of everything. But today what I want to chat with her about is kind of her real estate experience, how she got into buying real estate, and what her property portfolio looks like now.
Okay. Thank you for having me. I've been waiting for this. Okay. So I started my real estate portfolio in 2006. So about 20 years ago, we bought a bungalow. And at that time, the bungalow was $236,000, which at that time we thought was super expensive, and we were a little nervous. We had our own property, and we were a young family at the time. But we bought it, and we got a mortgage on it, and we found a tenant for it. And actually, for that specific property, the tenants are still there. So 20 years they've been there. So that was our first property, and then we bought another property, a condo. We actually bought two pre-construction condos in late 2007 and 8. And then I bought another condo, which was already built. It wasn't a assignment. It was built. My clients had closed on it, and they wanted to move their money somewhere else, so I bought it from them because I thought it was good value. And then we bought another bungalow. So in total, we have 5 investment properties in the city of Toronto, which have been really good for us.
So 6 total, including your principal residence.
Yes, and then our cottage.
So 7 properties.
Yes, 7. Sorry.
You didn't round up properly. Did you use any of your original to trade up into the next? Like, were you refinancing? Were you renovating? What were you doing to get to the next point?
So the first property, when it increased in value, we actually pulled a little bit of money out of it, and we had some of our own money. So together that put the down payment on the next one. And then same thing, when the second property increased in value, and from those times, like, values were going up. So every few years we were able to pull a little bit of money out of them, and then with our savings as well, put a little bit more in and put another down payment. So it wasn't we had a bunch of cash sitting around. We actually saved and watched the market, and when it was time to refinance our mortgage, we would see if we can scrape a little bit from here and put some of our money and put another horse in the race, as we call it.
Okay, and just to explain it to everyone that's listening to, what refinancing does is you go to your bank, you ask them to come in, reassess the property value. The bank will reassess it. If the property has gone up in value, you can pull out almost 80% of the appreciation value. So again, that's the rule of thumb. Sometimes things are a little different, but if you could pull out 80% of the appreciation value and use that money for something else, what could you use that money for? You could use it for another piece of real estate. So that's kind of what Georgia was doing. And then besides just taking that money out, she also compounded a little bit of money that she was saving to help buy the next.
Yeah, not every property had enough built up equity, but again, we would save and we would pull out a little bit. Again, it was, price and property specific. We would see at that time if we were able to do anything. And if we were, we would decide, we'd say, okay, we're going to start looking now for something. And they were decent value deals. They weren't always steals, but they were good value properties. We have to be careful as agents when we're buying real estate, so they can never be a steal, but they could be, good value. So we looked for things that were good value. And at this point, I say to myself and my husband, there's no way we would have saved any of that money that we have built up in our equity there. There's no way, with kids and work and day-to-day expenses and house and insurance and groceries and just everything that we spend money on, especially today. The equity we have there is sort of untouchable, right? We can't really, it's not like a bank machine. We could go in and maybe refinance again, but I'm saying it's safe there, and it just, mortgage gets paid down, equity builds, prices typically are going up. Typically, we have a bit of a blip now, but I mean, the big line's always up, right? It's long term. So
And out of curiosity, because I know everyone always asks this question, you own investment properties. Are they cash flowing? Are you kicking in any money? How did it work with your portfolio?
So the first 1 and 2, I think, were breaking even. To be honest, we never really needed to be making money on them. I'm employed, my husband's employed, so we didn't really want necessarily more income on our income. So as long as they were breaking even, or even if we had to put a little bit in, right now they're all more or less covering, and if not making a little bit. But again, we bought them several years ago. So, it was a different price point. The mortgage has been paid down. But there were a couple of properties, a couple of times that we actually had to, put in $300-400 a month to carry them. But, I thought of it as an RSP contribution or a mutual fund, contribution, or saying, put this aside for the future. Because that's what this is for us. It's our retirement.
That's a great way of putting it. So you're self-employed. I don't know if your husband is self-employed or not.
No.
Okay.
No.
But if you were just looking yourself, real estate, when you say it's your retirement plan, can you kind of walk through how you view it being your retirement plan?
Okay, so my husband works at a big Canadian corporation. He's built up, he's been there several years. He's going to have a pension that he's going to be able to tap into when the time comes. I have put money aside for RSPs, but I've done nothing with any other type of investment except for real estate. So when I retire, whether that's 5 years from now, 10 years from now, 15 years from now, those properties will all be at a income producing stage, and that'll be my income plus a little bit from my RSPs. And I mean, if I'm selling real estate still, which I probably will be, but maybe not what I'm doing today, but even a few deals here and there, that'll sort of make up my income. But the rental income, because the mortgages will be pretty much gone, will be my income. And my husband will have his pension, and that's how we're going to live.
I always have this conversation, especially with entrepreneurs, because most people don't understand we don't have a security nest.
We don't have anything.
So
we don't have mat leave. We don't have pensions. We don't have. I think we're going to get something
in the
old
pipeline
age or something at some point, but we don't have what people that work at a full time employer-employee relationship get.
But it is a risk. Like real estate's one of those industries that there's high risk and high reward. So one of the not so great parts about it is there is no pension, there is no safety net. So us investing in real estate really is our only way of gaining financial freedom, because how else will we do it?
Yeah.
When you're talking with clients, when they're looking to invest in properties, because right now not everything is going to be neutral. If you're not breaking even, sometimes you do have to kick in money. What is kind of the number you're telling them is a safe number to keep kicking in?
It really depends on, I actually go through, and I give them 3 or 4 scenarios. I say, okay, let's look at a condo situation downtown. Here's what the numbers look like. Here's what you'd have to put into the pot to make it carry. Here's a little bungalow somewhere, maybe a little bit east or west of the city, so it's not over $1 million. Here's, something a little bit more savvy, like a duplex. And so I run numbers on 2 or 3 different scenarios if they say I want to invest. And obviously, I ask them how much they can put into the down payment, et cetera, and that's where I'm working on. I say to them, like, this might break even-ish. This, you might have to put a little bit of money into. This might be too much. So we kind of look at the 3 scenarios or 4 scenarios. It depends on what their budget is and how many options I can come up with. And we go through sort of what their level of, I can do this is okay. So I don't really have a, if it's more than this a month, you shouldn't do it.
I usually tell people that anywhere between, and this sounds bad, but anywhere between $400 to $1,000, if you're kicking in, it's okay. It depends, again, on the property. Are you looking for appreciation value? Are you looking for cash flow? Because sometimes you can get one or the other. It's sometimes not both.
Right.
Or at least not both at an extreme level. Yeah. So that's something to think about. You're going to have a higher chance of breaking even if it is a duplex or a triplex. You're going to have a lower chance of breaking even if it's a condo. There's different risks associated with all of them. If you have a multiplex, if 2 out of the 3 units are vacant, 1 is still paying. If you have a condo, there is no one paying.
If it's vacant, it's vacant.
Exactly.
Yeah.
So even your risk tolerance goes to that point as well. And if something is vacant, how do I cover it?
Mm.
I think we should kind of go into risk because you own multiple, I own multiple. And people are always going to ask, what happens if every single one of your places are empty?
So I can say in 20 years, I've never had that scenario. And some people say, well, yeah, you're a realtor. So no, I have done what I think is right for the unit. So I've gone in when tenants leave, I clean it up, I make sure I list it at a competitive price to be rented out again. I've never had a vacancy for more than 30 to 60 days. So again, if it's priced right, like sales, if you're priced right and you look good,
You move.
you move. And if you're not, you don't. So that being said, I really don't have those discussions with clients and I practice what I preach. I'm not pushing people to, invest, and I'm not an investor. I'm an investor. I'm a landlord, and I think I'm a good landlord. And a lot of people hear all the bad stories about being a landlord, but there's a lot of good stories. And it's not because I'm a realtor that a lot of my stories are good. It's because I've done my due diligence, and I do this for my customers, as you do. We vet people. I treat every tenant like it's going to be my tenant.
Yep, I agree.
And I think, like, do I want to be dealing with this person? So I don't think risk. I think long term. And I don't think anybody today who owns real estate is and doesn't sell it and keeps it for 10 years is going to say, oh, I wish I would have sold it. I can't see that happening.
Well, the conversations you have with most people and the conversation I have with most people, I regret selling it. It's not, I regret not buying something. They're never saying like, oh my God, I can't believe I bought this property. Like, it's very, very rare that someone says that about a property.
My good friend growing up, her dad was Italian, and when they bought a house, it was in an area in Scarborough, and there was a few for sale. So this probably goes back into the 60s or 70s, and there were 2 or 3 for sale, and he bought one. And she remembers her dad sitting at the kitchen counter saying, "I should have bought 2. I should have bought 2." Where I bought my principal residence, same thing, like what we bought it for and what it's worth today. And yes, we've had our ups and downs, but at the end of the day, we've done very well with even our principal residence. We often joke with my husband, we should have bought 2. We couldn't have afforded 2 back then, but no one, I don't think, is going to regret today. There's, again, a blip, and maybe we're not talking about pre-construction, some of the people that we're hearing about now. But I don't think anybody's going to say, oh, I should have sold it, or I shouldn't have bought this. There's no way.
Yeah. And the longer you hold a property, you'll always make money.
Long term.
Yeah.
Like everything else. Stocks, everything. So my financial plan says same thing. Long term. Long term.
There's also risk in every type of investment that you're making. Real estate's no exception to that. The risk is a little bit lighter, I would say, than other forms of investing. If you invest in the stock market and you lose your money, you lost your money.
Yeah. If you lose money in real estate, you still have like
you have
something.
A roof over your head.
Yeah.
So the great thing about that is the fact that you can actually still have something tangible. Yeah. If you don't sell it, you didn't lose any money. Absolutely. If you just hold it through the wave, odds are you will make money.
If you can keep it, I'm saying to my clients, keep it. Yeah.
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 That's all for today's episode.
Thank
I'm
you.
bringing Georgia back again next week. We're going to talk about what is a good deal in this market. Once again, this was Property Play. If you like content like this, make sure to like, follow, and subscribe.